What if I told you that you don't need $100,000 to start earning passive income from the stock market? Some investors start with just $100 and let dividend payments quietly build their wealth, month after month, year after year. This is dividend investing, and today I'm going to break down exactly how it works, the numbers you need to understand, and how to start your own dividend portfolio step by step. Let's get into it. What is dividend investing? Dividend investing means buying shares of companies that pay you a portion of their profits, usually every quarter, just for owning the stock. Think of it like being a silent business partner. You don't run the company, but when it makes money, you get a small cut. This is different from growth investing, where you're mainly hoping the stock price goes up over time. With dividend investing, you're getting paid along the way, whether the stock price goes up, down, or sideways. Why dividends create passive income? Here's why this matters for passive income. Once you own the shares, the payments come automatically. You don't have to sell anything or do any extra work. And if you reinvest those dividends instead of spending them, something powerful happens. Your money starts buying more shares, which then pay you even more dividends. This is called a DRIP, a dividend reinvestment plan, and it's one of the most powerful compounding tools available to everyday investors. Let's say you invest and reinvest consistently for 20 years. That small snowball of shares can turn into a portfolio generating real monthly income. Key metrics every beginner should know before you buy a single dividend stock. There are 4 numbers you need to understand. Let's go through them one at a time. Number 1, dividend yield. This tells you how much a company pays out each year compared to its stock price. A yield between 2 and 5% is usually considered healthy. If you see a yield of 15 or 20%, that's often a red flag, not a jackpot. Number 2, the payout ratio. This shows how much of a company's profit is being paid out as dividends. If a company is paying out more than it earns, that dividend might not be sustainable long term. Number 3, dividend growth history. Has this company consistently increased its dividend over the years, even during downturns? Companies with a long streak of increasing dividends are often called dividend aristocrats, and they tend to be more stable, established businesses. And number 4, the ex-dividend date, the cutoff date you need to own the stock by in order to receive the next payment. How to actually start investing. Now let's talk about how to actually get started, step by step. Step 1, open a brokerage account. Most platforms today let you start with little to no minimum balance. Step 2, decide between individual dividend stocks or dividend-focused ETFs. Individual stocks can offer higher potential yield, but less diversification. ETFs spread your money across dozens or even hundreds of companies at once. For beginners, many financial educators suggest starting with a dividend ETF to reduce risk while you're still learning. Step 3, turn on automatic dividend reinvestment in your brokerage settings, so your payments buy more shares automatically. Step 4, stay consistent. Even small, regular contributions add up significantly over time, thanks to compounding. Common beginner mistakes to avoid. Let's cover a few mistakes that trip up almost every beginner. Mistake 1, chasing the highest yield without checking if it's sustainable. Mistake 2, putting all your money into just 1 or 2 stocks instead of diversifying. Mistake 3, expecting fast results. Dividend investing is a long-term strategy, not a quick income hack. And mistake 4, ignoring taxes and fees, which can quietly eat into your returns over time. Realistic income expectations. So how much money would you actually need to generate meaningful dividend income? Let's do simple math. At a 3% average yield, a $100,000 portfolio would generate roughly $3,000 a year, or about $250 a month. That might sound like a lot to reach, but remember, you're not starting there. You're building toward it one contribution and one reinvested dividend at a time. The key isn't speed. It's consistency and patience. Let's recap. Dividend investing means owning shares that pay you a portion of company profits. Watch your yield, payout ratio, and dividend growth history. Start with an ETF if you're a beginner, reinvest automatically, and stay consistent. If you found this helpful, subscribe to Financial Blueprint Diaries. We break down investing, budgeting, and passive income strategies every week. And let me know in the comments, should we break down dividend ETFs next, or go deeper into individual dividend stocks?